The following program is paid for by Ruedi Wealth Management.
Good morning, and welcome to Paul Ruedi's On the Money. You're invited to be part of today's show. Call 356-9397. Opinions and views expressed represent those of the guests and do not necessarily represent those of the station. And now, Paul Ruedi's On the Money.
Well, good morning, everybody. Boy, do I have a show for you guys, for the listeners today. I mean, boy, the name Ruedi's all over this place. I got all three of my sons here. I have David Ruedi, who's a usual suspect on the show. Dr. Fred is in Europe, so we don't have Dr. Fred today.
I'm in his seat, and I'm trying to channel his brain power.
Good luck on that. We need it, that's for sure. And David is a certified financial planner professional with Ruedi Wealth Management and a retirement income certified professional. And Daniel Ruedi from Texas. So two of the guys, Paul and Daniel, are here from Texas, and they have their jackets on.
Oh, yeah.
Sissies.
It's cold. It's cold here.
Complaining it's cold. They're from Texas. And Daniel's a certified financial planner professional as well, and a retirement income certified professional with Ruedi Wealth Management. And I have certified financial planner professional Paul Ruedi, also from Texas, up for the show. Well, guys, it's been a long time since. Have we ever done it with all four of us?
I don't think so.
Yeah, you just don't want to remember it, right? Okay, so you can call in with your questions at 217-356-9397 or text us on the Castle Heating and Cooling texting line at 351-5357. You can also email your questions to talk@WDWS. We're not going to have any Facebook Live today, I'm told, but we are going to record it and put it on Facebook for those listeners, so I apologize for that. It's important to recognize that past performance is not an indication of future results. You should not make any investment decisions without first consulting your own financial advisor and conducting your own research and due diligence. Got that out of the way, guys. That's a good idea to do your own. Now I'm looking for my notes here, guys. Well, welcome from Texas. I'm literally looking. Okay, now we're back in line. I have to have my notes here. I forget.
I had a crisis moment, too, getting the Wi-Fi password here, because I was looking at a blank sheet as well. I was going to have to actually be smart, from my brain this time.
Well, again, Dr. Fred's not here, so I think we're just going to leave out the economic talk today. I think people can live without it for one time. And since all you guys are young folks, I guess, are you guys millennials or Gen Xers? You're millennials, right?
I think millennials, yeah.
I'm not sure what the difference is, but
I think it goes down to age 24, and I think up to age 35. It's somewhere here in my notes, but I think we all catch it. Actually, even Ryan as well.
Okay, and Ryan's here in the background, so if we need you, we'll call on.
Yeah, we'll tilt the microphone.
Anyway, the reason I bring that up is Investopedia, which is quite a site, and I think you were one of the top 100 most influential financial advisors in the country last year for Investopedia, Paul.
That was last year, though. I guess I got less influential over the last year.
Take it up a notch. They did a survey on the affluent millennials. I'm not sure what the definition of an affluent millennial is. Someone that can go to Chick-fil-A twice a day, I suppose. I don't know.
So the number they gave was about $130,000 in income per year. So millennials that are doing pretty well. I mean, the average millennial household, I think they said, was at about 70. So almost twice the average household.
Well, that's pretty high. I mean, that's significantly higher than I would have expected. So I guess, I think most people would probably, this day and age, at least around here, think anybody in that category would be affluent regardless of age. And showed in spite of high incomes, they weren't very confident about the money concepts like saving and investing. And that's the reason I wanted to talk about this today, is because it's such an important time in your life. I always tell young people that your most powerful investment dollars are the ones you invest early in life, because they have a time to compound so much longer. And that extra 5 or 10 years just does mind-boggling things. Paul, you sent this to me. What surprised you about that after reading through that?
Well, I thought it was kind of interesting that millennials that have this high income very early on, you would think they would be well set up to retire early, or really to kind of have any financial option they wanted. But if when they surveyed people, about half of them said they thought they would be forced past normal retirement age. And that's kind of interesting, because there's not really any reason for that. If you're young, you have a high income, likely lower expenses than you're ever going to have in the rest of your life. You can save a lot. It can compound. There's really not any reason you shouldn't be confident about retirement. So it's really just a lack of knowledge in general, I think, that this point's at.
Well, but Dave, you made comment a couple of years ago about when you worked at Dimensional Fund Advisors down in Austin, Texas. You both did, Paul, you did as well. But David had mentioned to me once that they'd go out with people they worked with, presumably in similar age category. All certainly were in that affluent zone.
Right.
The kind of the mindset about the spending that's going on. Just kind of bring up what you noticed about some of the affluent, actually maybe many of the affluent young people you worked with.
Right. Well, and I think the comment I made was that it was funny how, I would work with people at different income levels, and at every income level it was like they would kind of not complain but just comment how hard it was to save money for things like retirement and their children's college education and stuff like that. And it was just funny how there was almost no relationship or tipping point where that stopped. Even the people who I knew were making really good money would still have those same comments. But it was amazing to see, some of the people who were more in my level, the lower levels, but still having a good income would complain about how hard it was to save. But then I'd see them dropping, $200 on a weekend of, restaurant meals and drinks and things like that. And they'd have, a new suit every month, and you start looking at these things like, well, I can tell you why you're having a hard time saving. It's really not a mystery. And that's the thing is it's easy to just inflate your lifestyle. And when you see everyone else, when you're an affluent millennial, a lot of times you're friends with other affluent millennials, and you have the same problem as the rest of the country, which is keeping up with the Joneses to be kind of...
By the time they're 60, they'll figure out even the Joneses can't keep up with the Joneses, I suppose.
Well, and generally when you're affluent, you're working really hard, too. And the mentality is, I'm working so hard, I can treat myself a little bit. And it's kind of funny. It's people kind of wait or kick the can down the road. I can save once I get to this higher income. Even the same people I've watched since college, guys started making $50,000 straight out of the year. Like, if I could only make 60, that extra 10,000 would really be the icing on the cake. Well, they get a promotion. They make 60. You know what they start saying? I barely got my bases covered. If I could make 75. I mean, I've seen this happen. This is someone I'm speaking from experience. He's making 90 now, and he's like, gosh, if I could only make that 110.
Yep.
So it doesn't go away.
It really never stops. And I think especially the two big expenses, and I just submitted a proposal to a reporter about this because it was talking about expenses people can cut to save more for retirement. And I said, a lot of people worry about every nickel and dime and cutting out lattes and things, but at the end of the day, I see the biggest issue is people get the absolute biggest house they can afford and the fanciest car they can afford, and then just those two payments eat up so much of their monthly income. There's not a whole lot left over. So I think those are kind of status symbols too. So those are the particular areas where people who are affluent, even the younger people, you start looking at houses and you want to buy a nice house and
that's something that
get away from you.
Yeah, that's something that just doesn't end, though. If you begin that way, it strikes me that's a cycle that I see people that are in their 60s that still have that same affliction. They feel like they still have to have, the conspicuous consumption, And I tried to tell young people, look, that new BMW for $80,000 isn't a status symbol. It's an IQ test at the end of the day. And but again, I see people driving these $80,000, $90,000 Suburbans, and it's a 28-year-old or a 32-year-old, person driving around their children, and I'm thinking, holy cow! It's funny as I get older. I think it's as common too. You start looking back and you go, I really don't care what kind of car I drive, or I'm not really trying to impress anybody. And I think that's really hard to do when particularly if you're affluent, running around with affluent people.
And one thing I've noticed is there definitely seems to be a relationship between people whose parents were pretty frugal and then their children leading that frugal lifestyle. And I think we probably have more of an older client base listening to this show, but I have noticed that parents who instill that in their children at a young age, it really does seem to have an impact, at least among my friends and people that I know. It's the parents who led kind of flashy lifestyles, their kids kind of lead flashy lifestyles, and also the opposite was true.
Yeah.
And that actually, the behavior side of what you learn from your parents really kind of has an impact on how confident
wait a
you
minute,
are.
guys. This isn't.
I know.
This isn't an intervention.
Yeah,
about me, is
yeah. Before we get to the bad stuff, let's talk with the But one of the things that the study mentioned is, in spite of these millennials having a lot of money, and this is actually a pretty common problem, people can make a lot of money but not be very good with managing it and spending it and investing it. And when they looked at people, and I'm sorry, I'm going on a Paul Senior tangent. I'll get back to the parent behavior. when they looked at millennials, only about 37% were knowledgeable about investing. And these are affluent millennials who really should be knowledgeable because they have quite a lot at stake. They might actually have assets to invest. But one another interesting thing that came out of this study was how early you learn about financial behaviors makes a big difference. Like if you learn before age 5, which we probably did, Pops. I think you did that one right.
Yeah, I think
You're
before you learn the birds and the bees, you learn the difference between stocks and bonds, is my guess.
Well, that was a shortcoming in a whole different ballpark. But that explains other problems down the road. But
oh, by the way, we'll have that talk after this.
Yeah, there we go. We're still waiting on that. But yeah, the earlier people, and the earlier you teach your kids about money concepts, the more likely they are to be confident with them, and that's going to keep them from making bad behaviors, because when people aren't confident, and this showed up in this study too, they're more likely to make mistakes like not saving enough or investing too conservatively because they feel stocks are quote unquote risky. And these are millennials, right? These are young people that have 2 or 3 decades until retirement. They should be in stocks, but the study actually showed they were less likely to own stocks than people who were a generation older than them. So there's just, I don't know if it's maybe the fact that we graduated mid-2008 that there's that risk aversion there. I mean, Dave, what do you think about that? You're nodding your head.
Yeah, no, that's actually what I was going to say. I wonder if it has to do with kind of the time frame that we lived through and got our first jobs in. I think Ryan graduated, or the other advisor in the office graduated in 2008. And I think everyone saw, they had job offers and now they don't have job offers, and they saw their parents, take huge hits in their investment portfolios. And if you don't have that education, you hear the horror stories of the people who, quote, they basically had permanent losses because they panicked and sold. But, no one's telling them, well, if you just don't panic and you don't sell, those types of things aren't going to hurt you when you're young and you're saving. People don't have that perspective, so they just view it as risky.
And contrast that with me. I graduated from college in 1982. That summer, the Dow started in August of 1982. The Dow was at 777, if you can imagine. And, of course, I enter the marketplace and in the investing world during one of the greatest secular bull markets in history, and how you guys could probably understand why I have zero fear, even for people in their 60s or 70s, of having a substantial portion of a portfolio in the great companies of America and the world. So how and when we learn this, I guess that's the question we might want to talk about next. Dan, you got a point?
And we'll see if you agree with this, but I figure I was a finance major, and even within that framework, I found myself out of school asking Dave and Paul a lot about more like real world finance issues. Well, what credit cards do I get? Things like that. I feel like to an extent, none of that gets talked about. In high school and even in college, I feel like there should be some course just called real world finance, what you need to know to be, successful.
Well, and especially when it comes to investing. So kind of credit cards aside and things like that, there's very little investing education. Even being a finance major, the investment classes, they have to be really kind of careful not to lean too far one way or another. And they go into like fundamental analysis of individual stocks and things that really aren't practical, like you said. Right. And really what people need to know is, okay, well, how do I pick funds in my 401k, like first and foremost? So,
and what are the implications of investing in bonds for the next 30 or 40 years while I work versus the great companies of America and the world? And those implications are huge. I mean, it's different, and very few people. I think that one of the things I was going to bring up, presumably these fairly affluent young people, probably most of them are pretty well educated, but even with that, only a third of them roughly feel like they're knowledgeable at all.
And one thing I talk about with retirees that is even more so the case with millennials and younger people is that conservative investments, people will say, well, I'm risk averse, or I don't want to take investment risk. And really what happens is if you invest too conservatively, you're just exposing yourself to a different risk. And in retirees, I talk about you're exposing yourself to the risk of running out of money. Or even if you don't run out of money, you're exposing yourself to, I guess you could call it the risk of a substantially reduced lifestyle, because you're going to have to spend so much less by being invested so conservatively. And for younger people, if you don't invest your money pretty heavily in stocks or stock mutual funds, you're running the risk of never being able to retire with the income you have, or having it take 20 more years, or you have to save twice as much. The magnitude of the effect of being risk averse or excessively conservative, it's just huge. And like I said, it is a mindset shift. There's really no such thing as not taking risk. It's which risk are you exposing yourself to.
So we're always just trading one risk for another. But we may not realize that, but in the end, that's what we end up doing. I think that's fair to say. Well, if less than half the affluent millennials feel confident about investing in retirement planning, as the survey showed, that low financial confidence has manifested itself as basically conservative investing habits. And what a tragedy at a young age when you look at the difference between, and really, I think that I step back and I think so many times it's the industry that's caused this problem, because when we think of being conservative, we think of that's being wise. We think of investing in the stock market to the extent you're at least broadly diversified, in all fairness, that's a risky strategy. And everybody has to back up and say, well, it depends what it is we're after. What is the purpose of the money? And I think so many times these things just by default happen in a silo without anybody stepping up and saying, well, it kind of depends what you're investing for. I mean, wouldn't you guys agree with that?
Yeah. Go ahead, Dave.
I was going to say, for sure. And when you're going to need the money is kind of a huge influencer. So for younger people, when you're not taking money out of your portfolio, you're adding money to it. If anything, those declines can be viewed as somewhat beneficial because you're getting to buy the same shares of the companies you were buying, the year before at a significant discount.
And I noticed that a good number of them do trust financial advisors, because we're all being told that young people don't want to deal with financial advisors, but the study didn't show that. It showed that 27% of those who reported using a financial advisor said their investments perform extremely well, double the number of affluent millennials without financial advisors. And 65% of the affluent millennials surveyed said they trust financial advisors. I think that's interesting because we're kind of all being told in the industry, us old guys, that we're going to be displaced because everybody's going to do it on the computer. And I think there's going to be a lot of that, I'm sure, and that's something we're even embracing ourselves. But I was interested to see that 65% of them, saying that they do trust financial advisors. And when they explain why, it's the same reasons the 60-year-olds seek out advisors. Personal connection, training, schooling, etc., ability to have a two-way conversation, and develop personalized strategies. Again, we always think about you guys just doing nothing but playing Nintendo and don't even need to talk to people, and just staring down at your iPhones. But in reality, it's that human nature that we so often talk about. People don't change after hundreds of millions of years of evolving. We tend to be very social people, trusting people. And, we're always, I think, in general, human nature leads us to seek out wise counsel and to have that two-way conversation and that type of relationship. So, so there, I guess. You guys look at me with a blank stare like, oh, I guess Dad said it all. So that's why I explained. So I thought that was interesting. And then kind of leading into that, Investopedia in the same group talked about the robo-advisors. When we talk about robo-advisors, that's what we're talking about. We think that these young people that grew up on Nintendo, is that what it was? Or so Xbox, I guess.
Well, when I was growing up, it was Nintendo 64 was kind of like the game changer.
Okay, see, I'm hip.
So, yeah.
I'm sure I bought that.
It's not so much anymore, though. So
yeah, they've kind of gone out of favor. It's more, Xbox and PlayStation these days.
Well, 20% of the affluent millennials ages 23 to 38 use robo-advisors. Respondents who reported using robo-advisors are twice as likely to manage their finances daily, which suggests digital platforms tend to attract more engaged investors who want to actively manage. That, to me, when I read that line, it could mean a lot of things, I suppose. If it's like politics, some people read the same thing and they see two completely different things. That does worry me a little bit, the more people focus on their daily investments and how they're doing. My experience watching people for 35 years says not a good thing. The more, I tell clients, money is like soap. The more we mess with it and touch it, the smaller it gets. Do you guys see concern from your perspective at your ages that the fact of using a robo-advisor might, and now we're hearing that, I don't know about robo-advisors, but now many major brokerage firms saying you can trade stocks for free. Is this going to lead towards maybe some bad lessons?
I think it could. And actually, when I read that line, I was like, ooh, I almost want to delete that from the notes because I know we'll end up talking about this. And I think, they didn't distinguish between monitoring and making changes because I think there is a certain degree that it might be a good thing if you're achieving or looking to save towards short-term goals and you're looking to see your money add up every single month or probably not every day. But I think there's a certain degree that a lot of millennials do the head in the sand approach to their finances, and merely being aware of everything and having it all in one place can kind of benefit them. And actually, in the study, they showed that people who use robo-advisors are twice as likely to say that they're confident about their finances than they are not confident. And when we were talking about how all these affluent millennials are not very confident about their finances, that's a pretty big difference maker, just to be able to have that confidence, because then that might start trickling down to better investing habits or better saving. Just having a better knowledge of your financial situation might make you more confident.
And one of the advantages of using a robo-advisor, these are basically just, when we say robo-advisor, we ought to define it. It's just basically an all-digital, tend to be no person involved. It's just all digital. You move money around yourself, and they make it quite easy, I must admit. And one of the advantages, of course, they usually require very small account minimums from what I can tell. And I can see that being an advantage for people. And the final thing on that is 31% of those aged 18 to 22 use robo-advisors, compared with only 9% of investors aged 47 to 54-year-olds, suggesting acceptance of digital advisors is increasing with each generation. And that makes sense. I mean, I expect that trend to continue. But at the end of the day, as the stakes become higher and we get closer to retirement, I suspect there's always going to be that demand for that. Well, I'm not sure I want to do this completely on my own. I don't know what you guys think about that.
I completely agree, but I think there will also be kind of a demand to work with those infrastructures. So if people have, a certain robo-advisor, they have a certain application they like where it keeps everything in one place for them, I think there might be an opportunity for advisors to sort of quarterback certain financial decisions, but then let those low-cost infrastructures take care of people.
And that's basically, Daniel, when you decided you thought we should, and we all agreed, should set up our Ruedi Wealth Management co-pilot. That was really kind of to create this ability for younger people, and not just younger people, basically to have that, I can see all my money in one place. I can transfer money from my bank account there if I want, just by push of some buttons. It's easy. I don't have to talk to anybody if I don't want to do certain things. But at the same time, what you guys have integrated is then you also have access to a certified financial planner professional, a real live body to run questions by, or run strategies by, or allocation questions. So what was Dan, you're kind of the one that ran with this. What was your thinking that 60-year-old dad's firm who's been around for 35 years, it's just completely in the retirement planning business, in the retirement investment business, why is it that Ruedi Wealth Management now has adopted this co-pilot, which, by the way, means that, I've talked about this in the radio before, the nature of our business is you tend to increase your account minimums over time because there's only so many people you can work with one-on-one. And this allowed us now to basically take our brand, to the extent we have one, for people who have much less than that. I think we're saying as long as you have $25,000 to invest, it's eligible, and probably reality is you probably don't have to have that, but we're trying to at least stick there. So what was your thinking on that?
Yeah, I mean, as you can tell from the article, that the world is going that way. And not only that, I feel like people my age personally, I don't necessarily need to go in to see someone, but I'm not totally going to trust just an electronic platform. I need someone to go, hey, I kind of did all this, but does it look right? Check my math. And that's kind of what we're here for. And there's just certain life things that you need someone to talk to for the big decisions. It's not just, it's very hard to just look at, well, there's the math, that's what I should probably do. And then you're like, well, this robot's telling me to do it,
Yeah.
And it's like, it's just a mental thing.
What do you think, guys, the first time we hit anything remotely like 2008, 2009, for people that are using the purely just digital platforms, how would you guess that's going to shake out? Do you think and again, I'm not trying to skew this, I promise, towards you. Everybody needs an advisor. One of my concerns with people that do a digital-only process is that's fine. And if anybody's noticed that this robotic or robo-advisors are basically a result of a major 10-year bull market. I mean, this is a bull market phenomenon. I always wonder out loud sometimes, because you hear me, how many people are going to be able to not panic and sell when they really don't have somebody to talk to. I mean, how many times have you heard me tell clients, you don't want to do that, over and over, more than you guys care to a point where the clients don't even bother asking because they know that that's going to come out of my mouth. You really don't want to do that. What's your take on that? And then how are we going to address that with Ruedi Wealth Management Copilot? Is that where having the certified financial planner professional basically on deck helps?
I think it is, and actually, when we were designing the program, all of us got together and we said, really, what do we need to do on the front end to get these people onboarded and kind of understand how the game works, And part of that is giving them really good expectations of, here's kind of what your portfolio could look like in a bear market scenario, and guess what? You might get that 1 out of every 5 years. And when that does happen, you know what you're going to be doing? You're going to, for most people in this type of platform, you're going to be contributing at lower prices and gaining more of the stocks that you need already. But it's a matter of framing an issue to, first off, let them know that this is a possibility, so there's no surprise there. But when it does come up, and they will, they'll call. And especially for the newcomers, they don't totally know how this is going to shake out. We're on social media all the time. People are saying, sell from your 401k and all that. And that's when they're going to call me and make sure, hey, do we need to do anything? And I can reiterate, on the front end, this is what I said. This is just one of those times, and we're going to keep plowing through it and, do what we need to do.
Yeah, and that was kind of my insistence that, hey, we're not going to have a purely robotic advisory. We're going to allow people to have access to certified financial planners at those pivotal moments when they feel like making a mistake. Sometimes it's not just out of pervasive pessimism. Sometimes it's, like in the late 90s, all you needed to do is invest in 3 companies and you were all going to get rich. And, I don't know how many times I had to tell people you really don't want to do that. And I'm hoping that addresses it. So we're pretty excited about Ruedi Wealth Management Copilot. The easiest way to find it is still to go to our website. Is that?
Yeah, and I think we're really excited about this in particular because it allows us to work with younger people, at least our age. Because we were kind of sitting around thinking, gosh, there's so much at stake for young people. They have all these decisions that get compounded over 3 decades, They don't really have the confidence to make them, but if they make decisions like invest in bonds versus invest in stocks, it has a huge impact, and we know that impact. So I think that's why we're really passionate about helping people up front before they make the mistakes. I mean, the way I phrase it is, we used to have a $500,000 minimum. Now we would really like to take people our age and grow them into those $500,000 or $1 million clients, because we know we can with good decision making up front. But they just need to do it up front. That's the difference maker. You can't go back and fix mistakes after the fact. If you can get them in advance, it just puts all the wind at your back.
Some of those mistakes can be critical, particularly, as you said, the mistakes also get compounded over long periods of time. So I think it's pretty exciting. I think it really opens up the world list. You guys have mentioned a few times the word surprise. Is that just because you've heard me say surprise is the mother of panic? Is one of your biggest takeaways as being a financial advisor? Well, I'll tell you what mine is if we can set, and Daniel said it, if we can set expectations up properly, that means people shouldn't get surprised. And if they don't get surprised, then they don't panic. And if they don't panic, they don't sell in the mix of everybody else, in the midst of everybody else selling at the same time. When every talking head on TV and on the radio is saying, sell now while you can. I still remember my scathing email I sent to CNBC. I think I tweeted it. That's why I stopped tweeting. I was getting banned like Donald Trump. Not that he's bad. I just mean his tweets got to get out there. And I found myself arguing with people I'll never meet, so I stopped doing that months ago. But I remember, and this was probably 4 or 5 years ago, one of their experts on their panel was saying, take your 401k and sell it all to cash. And I about jumped through the screen. But this is, at these times, these pivotal moments I talk about, that's what they're hearing at those times. So if we can keep them, so again, I guess it sounds to me like what you guys are saying is manage expectations. They don't get surprised. If no surprise, no panic. And if there's no panic, then we don't have to try to overcome these huge obstacles.
And lately an example is just that I've had to explain to a few people, or just kind of reiterate, that a diversified investment portfolio is going to behave differently than the benchmarks that you see on CNBC, and that's something I'm trying to be better about now up front, because we do have globally diversified portfolios, and I always have to basically say, look, if you go on CNBC and you see the S&P 500 is up X% today, your portfolio will be different. One way or another, it will be different, and by definition, some of the time it's going to be different in a bad way. And that's just normal. Anytime you have a diversified portfolio, there's going to be periods where you underperform the S&P 500, and that's what's been happening recently to people who are diversified. And that's just one example of how I think I could have done a better job up front setting expectations so that people aren't surprised or as bothered by it. But at least having that person there when you are going through it, even if expectations maybe weren't set as well up front, you can help them feel better about their portfolio and not feel like they need to make a change.
In other words, more of a test drive ahead of time. I think we've done a really strong job at having people recognize that part of investing in the great companies of America and the world, at least to the extent you do, is going to come with periodic times that are going to be unpleasant, temporary declines, if you can see them as temporary along a permanent uptrend. But it's also, there's other areas that people can be surprised, which can derail their plan. And one of them is, well, very few people argue that diversification makes sense. Very few people. You usually, you'll get some people that will just, but they're making an argument for a wrong idea as opposed to trying to find a right idea. So very few people that are, halfway intelligent would say that you shouldn't be diversified. But then I don't think we or anybody maybe has done a good enough job of saying, what does that really mean when we say diversification? It's not just that you're spreading out your risks, and there's safety in numbers. It's that it's going to behave by its very nature. We are diversifying because we want it to behave differently than that benchmark. Otherwise, we could just buy the benchmark, and now we're not as diversified. Is that fair to say?
For sure. I think so.
And so, that's one of the things that I think that, all advisors and all investors are getting better at, is really, and of course the hallmark of my 35 years, I think, has been just trying to get in front of those issues and keep people from getting surprised. We're going to switch topics, Paul. You wrote an article called The Financial Black Belt. It's your last post, and kind of surrounded about the idea that down in Texas you're starting back to the Brazilian Jiu-Jitsu, which is a form of martial arts. I think of it as in terms of wrestling. You can clarify that if you want, but it's a pretty hard workout from because I used to do it, and after about 2 minutes I would start seeing stars. So that was back when I was younger. But you started back to jiu-jitsu, and in your most recent blog post, you kind of related how to become a successful investor, have a successful financial life as it relates to going through the steps in any jiu-jitsu is like other martial arts. You start out as a white belt. Kind of take me through where that clicked, and kind of like, I thought it makes sense because you can't start out as a black belt. You're going to get beat up and you're going to quit. So let's start with the very basics. Once you get the awareness, you may find you want to be more deliberate about how much you spend. That's one of the things you brought up. Are we at the white belt level there?
Yeah, absolutely. I think our notes might have jumped on you a little bit. Because, where I'm at in my training right now is I'm in a unique position because I'm a 30-year-old, and when you're 30 years old, generally you're used to doing things that you're good at. But I'm starting at a white belt because I never progressed past white belt when I was an 18-year-old, and about 12 years has passed of not doing jiu-jitsu. And it's a little bit like riding a bike, but even riding a bike, sometimes you got to refamiliarize yourself with. So, I'm back kind of struggling, taking my licks at white belt. And at this point, I really admire what a black belt or a brown belt or really even a blue or purple belt. I mean, they can all kick my butt pretty handily.
But that didn't happen overnight, right?
It didn't happen
They
overnight.
also started at a white belt.
And you can't just jump straight to the most advanced techniques without just getting the fundamentals down first. And that was kind of the premise of the article, right?
That's exactly right. Yeah. So what you really need to do is you need to start with like some of these really basic, fundamental, foundational things when it comes to personal finance, like managing your spending and making sure you're saving. And then once you get those things taken care of, then you can kind of start worrying about these purple belt moves, like how you're going to tinker with your investment portfolio. But you kind of need to do one before the other because, like you guys mentioned, if I'm a white belt and I'd go right to training with a purple belt, he's just going to steamroll me. So I can use purple belts to guide me, but I shouldn't necessarily compare myself to them. I got to focus on the fundamentals before I can actually get there. So yeah, I mean, you don't really get a refresh to start at a complete blank slate white belt. And I was even thinking in personal finance, like there's a certain degree that we're advisors and we write a lot about like purple, brown, and black belt stuff. Because that's interesting to us, and that's what we're wrestling with in our heads. But those, quite frankly, people need to get past white belt and blue belt. And I even see this in jiu-jitsu gyms sometimes. They're working on advanced moves. I was like, I need to know how to get to this move kind of situation. So that's what it's really all about.
So I'm going to back up one stage in front of that because I think it also relates to why people sometimes are challenged by becoming successful financially. It takes a lot of guts to walk in the door the first time.
Absolutely. And you're, like I said, you're going to get your butt kicked, right? Like you're not going to have linear progress the whole time. You're going to run into that guy that steamrolls you. You're going to have injuries. It's not going to be an uninterrupted progression. So yeah, there's a certain degree that you need grit just to do it. And that's why I think jiu-jitsu is a great example. I mean, it's not, it's not ping pong. It's not hockey. It is. Hockey's a tough sport. I'm sorry. I meant to say golf. Not to say that's not easy. I'm not saying it's easy. I'm just saying it's not physically demanding on your body. No one's trying to choke you out in golf or ping pong. I mean, people, when you're wrestling in jiu-jitsu, they're trying to hurt you. I mean, they're not really trying to hurt their partners, but at the end of the day, they're trying to take you out. And that's tough on you. And quite frankly, the financial world is trying to take you out. They're trying to sell you all types of stuff that you don't need. They're trying to create spending habits that aren't good, investment portfolios that aren't right for you. So yeah, I mean, you can.
So kind of to all you guys, what are some of the white belt issues in finance that you guys can think of? Just those very basics. I'm walking into the room the first time. I'm a little nervous about this. What is I need to be working on to get through that white belt issue?
What's kind of interesting to me is when you were in Texas, actually, my cousin was asking you, I want to start investing. How do I do that? What should I do? And the thing is that's kind of one step ahead. You're like, hold on. Do you have any credit card debt? Well, no. Okay, do you have an emergency fund? Well, no, really. I don't. Not really. Well, you really need to get an emergency fund first before you can do the investing. And that's kind of, that's a really important step. And I don't think some people know that. It's people are either really conservative or they're like, I want to start investing now. And it's like, well, do you have your emergency fund set aside? Because that's a very important part of the actual investment component,
Well, and one of the things Paul wrote about, too, that kind of goes in this section is just a general awareness of your spending and kind of knowing how much you're spending. And I think that applies to young people and older people. I just wrote an ebook about basically figuring out if you're ready to retire and then kind of walking people through that process. And one of the first steps is figure out how much you're spending now, because you need to know that, because you need to know how much income you're going to need when you do retire to continue leading the same lifestyle. And I think that's just a fundamental thing, regardless of where you are in your life, to kind of have at least some grasp on it. No one knows, well, very few people know to the penny. I don't, but having a general concept.
And that was just what I was going to say. I mean, you don't really think of that as really even getting you anywhere, just having an awareness of how much you're currently spending, but that's just a step that you need to take. I mean, the jiu-jitsu analogy, it's like, well, don't leave your arm hanging out there, someone's going to snap it off. Like, you need an awareness of the things that you might be doing wrong before you can even...
Some of the obvious ones.
Right.
And then as we move on to the next blue belt level, is that the next one?
Yeah, I mean, there's a few more steps at White Belt. I mean,
let's
in
talk about
particular,
those, because those are probably more important.
yeah, well, and they're all kind of interrelated. I mean, once you get an awareness of your spending, you might find that you want to alter your spending a little bit, maybe to have a little bit left over at the end of the month, or you just realize, oh my gosh, I'm spending 3 times as much as I should eating out or on entertainment. You know, that's not to say that you should live the frugalest lifestyle possible, but you might want to make some changes. So my next step would be to create a budget and make sure that you spend less than your paycheck, which sounds easy to do, but sometimes little things come up and you have, you know, your cable bill, your phone bill, everything just, it can kind of add up. So you need to be really deliberate about spending less than your paycheck, because if you're not spending less than your paycheck, there's no money showing up to start an emergency fund, to pay down debt. Those are the next 2 steps, by the way. I don't need to go over them because they're pretty much self-explanatory, but there needs to be money showing up so you can actually get traction towards these goals. And you have to work on that before you even think about which debt am I going to pay off first, or where, you know, how am I going to save? You need to actually make sure there's something to save.
So a question we get, and this is a little bit of a tangent but kind of related. So we get this from retirees, is speaking of an emergency fund. It's like, do I still need an emergency fund as a retiree when I have this big investment portfolio? I'm curious if you'd want to share kind of what you tell people.
Well, I've noticed, again, I've been doing this for 35 years, and prospective clients almost see me, wow, he's a mind reader. You know, it's like, no, this is what 35 years will do for you. I've noticed that virtually every person entering retirement and in retirement has a certain number that needs to be in their checking and savings accounts for them to relax and them to have the comfort that they're searching for. That, you know, we may sit there and tell them, look, you're underspending and you're fine, and there's no boulders running down the hill at you from a financial standpoint. I can't even think of scenarios that are really going to get in your way. But then they'll look over, and if that checking account's below 10,000, or for some people it's 100,000, everybody has their number, I would say. And I think it directly relates to, yes, people in retirement even still need to have that. I don't know what they want to call it, an emergency fund. It's just, I think in their mind, it's a in case of emergency break glass fund. It's a mechanism that allows them to really not be strained on a day-to-day basis and not second guess every normal purchase is, oh, I wonder if I can afford this. I think when they look over and they see that money in that fund, they go, oh, I guess, you know, the guys did say we could afford this, and my savings account over there is still just fine. So I think, yeah, very much so.
And that can actually bring us to Blue Belt, because I mentioned you might want to start contributing to some sort of emergency fund or paying down credit card debt in your White Belt stage. But once you get to Blue Belt, you're going to want to have that, whether it's 3 to 6 months cash. That's kind of the CFP recommendation. But as I was actually reading, you know, through some content for the show, I found a CNBC article that gave, because everyone likes exact numbers, right? Nobody wants to hear 3 to 6 months of expenses. And they gave an exact number about what's a good idea for an emergency fund based on research. And that number is $2,467. They did it to the exact dollar. But what they looked at is, they looked at 70,000 lower income households. In particular, I think this makes sense because these are people that need to save up an emergency fund. And, you know, that group represents about 30% of the U.S. population. And ultimately what they found is past $2,467, the incremental dollars that you have in your saving, it does reduce your risk of going into financial hardship, but not by much. So what they wanted to look at is, what is the optimum amount that we could set aside, not too much, that basically saves people from going into financial hardship. And basically your dollars up to $2,467 have a pretty big impact. Past that, they have less of an impact. So those of you who are looking for your exact number for how much to save, maybe $2,467 is right for you.
I also feel like it depends on what job field you're in, because I was reading this and they said that if it's a type of job that's very cyclical and you could be out of a job for a year, that person's obviously going to need to have more of an emergency fund than someone's like, well, there's a ton of my type of jobs, I can get another one in a month.
Or if you're in a union situation, or maybe at the University of Illinois, they tend to be a little more secure job. At least that's the impression I get, so maybe not as sensitive of an issue. I will add one thing. I would tell every young person, I've been consistent on this, I don't say it much, but if a person out of college, starting out in life, they said, how much money do I need to have in an emergency fund? I would say, I don't think a person can make a good decision until they have $10,000 sitting in a savings account. It's my number. I have no data. but it kind of makes sense because you're not as apt to make bad decisions because you're not pressed, right? You're not trying, so I think it solves a lot of issues. I don't know if 10,000 is right, but it seems like that's pretty reasonable for someone who's, out of high school education, maybe has some college education, actually in the real world with a job. Maybe it takes them 3 years to get there or 4 years, but they need to get there. I don't know if you guys sense on that.
No, I think that's exactly right. And, I know this is the less, exciting stuff relative to investing, but I think an important point needs to be made that you need to have that emergency fund before you can consider investing or consider taking out, maybe medium or low interest rate debt. Because as soon as you have something go wrong in your life, if you don't have that emergency fund, you'd have to sell from your investments, or you have to maybe rely on credit card debt. So now you start taking steps backwards. So you really need that financial foundation in order to be able to move forward to the next belts.
And one of the big ones you put on there under that, still the blue belt, which is still a lighter belt, though I wouldn't want to get in a fight with one, but start saving. And I think maybe this, after you have the reserves and all that, kind of the blocking and tackling done, I think the next one, if we just stop there, I could solve most people's problems at age 60. And that is start saving a fixed percent of your paycheck up front. In other words, pay yourself first. I've seen very few people that walk into my office that are the millionaires next door that didn't pay themselves first as a young person. What's your take on that?
Yeah, and most of it's 401k withholding directly from their paycheck, and they're getting a lot of times an employer match, and that's a lot of our clients that end up with, 500, 700,000. They were saving, 10, 15% of their paycheck from day one, getting an employer match, and just let it ride.
And what else did they do on the investing side that they did right to get to that 5, 6, 7, 800,000?
Most people say, well, I just didn't pay much attention to it.
And they didn't invest it. And I can tell you what they did not invest
Right.
much money in, and that is bonds. The one common theme we see, the difference between people walking in with 200,000 or 300,000. That's not a lot of money, and I'm not suggesting that that's a failure. I'm just saying there's certain things after all these years I can look back. I can look at two people that basically saved the same amount of money over the same amount of years, and one of them has 2 or 3 times more than the other, and it's that asset allocation decision, and that's a very important decision as well.
Yeah, and that kind of leads into the final bullet point for Blue Belt, and that's start investing and building wealth. And I emphasize putting stocks in your portfolio because most of these people, if they're trying to build their wealth, they're willing to take risk and they're accumulating, so they don't necessarily have to worry about spending from their portfolio. So that's really kind of like, now that we're at the edge of Blue Belt, this is when you're in jiu-jitsu, you've been training a couple years, you're familiar at this point. Only then do you start investing. You don't jump straight to picking stocks. You don't jump straight to choosing, this ETF or that. You have to set that foundation first.
Is that basically the building blocks of that part, just really as simple as that asset allocation decision?
Yeah, at that point, I didn't even go into it because I just said, if you're trying to accumulate wealth, and then this is really geared towards younger people. We traditionally write for retirees, but I'd say this one's more for like the people who are 20s and 30s, like, holy cow, I have no idea what I'm doing with any of my money. Those type of people, yeah, we recommend, especially in retirement accounts, 100% stocks, just to be able to build that wealth over time.
Well, and think so many people, they skip the first steps, but even if they are at the investment step, then they skip all the fundamentals of investing and start asking, well, which stock should I invest in? Or is this, particular very niche mutual fund a good fund? Or should I invest in marijuana companies? And very, very specific things that, first of all, tend to be bad ideas, but second of all, are just, they're things that just barely move the needle. They're icing on the cake. And it's like, at the end of the day, you need to first figure out how much in stocks versus bonds, then get broadly diversified. And then if you want, you can start worrying about little, like, kind of minutia like
but
that.
When we get back to that 401k, I think one of the problems, again, is the words that we use in an industry, not us specifically, but if I went and looked at 10 401k plans, they would show the 100%, the portfolio that's allocated 100% to the great companies of America and the world as a high-risk portfolio. Now, who wants to buy a high-risk portfolio? It's not a high-risk portfolio for someone with 4 decades of work ahead of them. I mean, there hasn't even been a 20-year period where stocks have posted a negative return. Not that they couldn't. Obviously, that's where the uncertainty is. But, again, part of it, you see a lot of young people, and I'll look at their portfolios, and they're the moderate portfolio. 60% of their money is in the great companies of America and the world, and 40% is in fixed income. And fixed income is after taxes and inflation going to provide them a return that it always has, somewhere close to zero. And, you know, if one thing I've noticed about the 401k plans that we manage, they're about 90%, you know, the money is in the great companies of America and the world. Some people would shoot at that and say that's too risky. I'm saying for 20 and 30 and 40-year-olds, the riskiest thing they can do is invest their hard-earned money in bonds for the next 30 or 40 years.
But according to that study, about a third of them do it.
Well, it doesn't surprise me at all. I mean, you know, a third of the people are fat, and we have all the studies out there that, you know, that show how you know, there's only two rules to not being overweight, and that is move more and eat less. But yet, probably a third of the people are well overweight. So see how this all circles back, guys, to, well, it's got this little problem, and the big little problem is not so little. It's called human nature, and human nature is a failed investor. Particularly when it comes to investing, human nature is a failed investor, and so this is a real, you know, I think if I could just mandate a law, be the czar, the 401k czar, I would say anybody under 40 can't have any, except for extenuating circumstances, cannot have any money in fixed income or bonds or savings accounts outside of their, of course, their emergency savings and their money that is pegged for needs in the next 5 years. I think that's fair to say. Well, we got one more minute, Paul. Why don't you go ahead and wrap up, kind of at the end of your blog, kind of the essence of it.
Yeah, absolutely. Well, we only got through half of it, so if people want to read, there's actually 3 more jiu-jitsu belts. There's purple, brown, and black belt. And at purple belt, we talk about getting your financial plan, getting your goals set. We do talk a little bit about the complicated portfolio stuff. Brown belt, I'd say the big difference maker is you want to start saving enough to basically make working optional. And then by black belt, you're at financial self-actualization.
Okay. Well, you can read that at RuediWealth.com, and David's ebook also at RuediWealth.com. Thanks for listening to Paul Ruedi's On the Money. We'll be back in 2 weeks.
Join us for the second and fourth Tuesday of each month for Paul Ruedi's On the Money. Views expressed represent those of the guests and do not necessarily represent those of the station. This is News Talk 1400, WDWS, Champaign-Urbana.